Hello. Welcome to CashFlow Hacks. I'm your host, Chris, and with me today is Stephanie.
Hi, everyone. I'm so happy to be here with everybody else who's ready to make more, save more, and live more now.
Well, you're in the right place because every week, Stephanie and I are going to share some strategies that your financial advisor doesn't want you to know. And why is that? Because the less you know, the more they make. And we want to help you flip that script.
Exactly. So this week, we're going to be talking about the 5 enemies of wealth.
The 5 enemies of wealth. What are they? Inflation, market fluctuation, devastation, litigation, and taxation. Today, we're going to cover inflation and market fluctuation. And then next week, we'll cover the last 3.
All right. Okay, so today, let's first discuss inflation. And as everybody knows, inflation is the rising cost of prices over time. So obviously, it's a destroyer of our wealth because in essence, we're declining our purchasing power over time. Our dollars are buying less and less and less. There are some people that I've spoken to that think that, you know what, Stephanie, if I just leave my money in the bank, I've got no risk. But that's not really true. And what I tell them all the time is, yeah, you're going to still have $10,000. And, you know, your $10,000 today, is going to be $10,000 in 10 years. But you won't be able to buy the same things in the future that you could buy today with that $10,000. Actually, you'd only be able to buy $7,600 worth of goods. So in reality, you lost $2,400. And that's risk. So leaving your money in the bank is risky. Because if you leave your money somewhere and it's not earning money, you're losing money. It's a known loss. Now, whenever I talk about inflation, I always talk about that it's averaged 3% over the past 20 years. And we, even looked at a chart together with Chris that since 1929, the average inflation rate was about 3.16. But Chris, you always advise that this is not an accurate number. Can you go ahead and elaborate for us what you mean by that?
Well, if you think about it, when you go to the grocery store, the last time you picked up some chicken, do you remember how much it cost you? Do you think that was only a 3% interest? The reason I say chicken is because one of my clients, she's always telling me that. Every time I go to buy chicken at the grocery store, it's even more money. And she said she's paying double for it now. So that's obviously more than 3%. I always tell my clients that if you're going to beat inflation, you're going to need to be making at least 10%. So if you have your money in the bank account and it's making 0, you're actually going backwards.
Right.
And, when you say 3%, that rate that you're talking about, that's based off of some items, like over 90,000 items that the Bureau of Labor has put together, and it's supposed to basically show, they figure the average of what the interest rate has went up, but they're not really using items that the general population, they're not using the right information. Just think about last time you went to the grocery store, Stephanie.
For me, it's eggs. I used to be able to get eggs for like $1. And now it's $4. I'm up here in Ohio. I know we're in a different state. Maybe it's chicken down there. But for me, I'm just shocked by the cost of eggs. So the eggs don't feel like only 3% because they're not only 3%. So like you said, that 90,000 items and the average inflationary rate of those items is not accurate for the things that I'm trying to buy specifically. And I think that this is a really interesting perspective, Chris, because numbers don't lie. But the way that numbers can be portrayed can be misleading, right? So we both agree that inflation eats away at your money, but you bring something that's unique because, in the traditional area, that I like to talk about, and it's always talked about that 3%, 3%, 3%, but you talk about like, I don't know if this is the right way to put it, but like that human real life perspective. It doesn't matter if 90,000 items average out to a 3% rate interest rate. What matters is the items that, the average American is buying like eggs and chicken, right, are a lot higher than that. So if, the people that we're talking to want to make sure that they're beating inflation, they need a lot higher than a 3% rate of return. So overall, if you're not getting a good rate of return on your money, or if you're getting zero because you're at the bank, it's detrimental to your wealth. It is absolutely a wealth destroyer, an enemy of wealth. So the next enemy of wealth is market fluctuation. Tell us a bit about how market fluctuation destroys wealth, Chris.
Well, so you know how I feel about the stock market. It's not all bad. However, it is a roller coaster and it goes up and down. And we're all happy when it's going up, but it really sucks when it's going down. But a good example of, when we lose money in the market, if you lost 50% of $10,000, that would put you at $5,000. But to get back to where you were, I'm not talking about growth, but just to get back to where you are, you need to have 100% gain. And why is that? Because, okay, so you lost 50%. If you only gain 50% back, you're only going to have 7,500 because you're only going to get it's 50% of the 5,000.
Right.
Does that make sense to you? You actually have to have 100% rate of return. And how often and how long does it usually take to get 100% return on the money that you lose in the stock market? 2008, when the S&P lost 49% and people lost 49% of their retirement funds, were they able to get that back in the same month, same year? No, it took a little bit of time. And so, yeah, that's how I think about market fluctuation. Is like, it really is. If we don't have to have the losses, if we didn't have to make up for the losses, we would be in a much better situation.
Yeah, absolutely. Because like you said, there is that situation where you have to take the time to make up for the loss. And because last year with our rising, inflation and interest rates, we actually had a fall in the S&P 500 of like 19.4%. And, to your point, you brought up some historical numbers. Last year was the fourth worst performing year in history, right? But what market experts like to do is they like to kind of see what has happened in the past and, look for markers that tell us like, okay, that saying history repeats itself, right? So they kind of look at what happened in the past, what could potentially be happening now. And so they're saying that this year, 2023, there could be a rebound. And they're saying this because since 1957, right, the S&P 500 fell in 1974, 2002, and 2008. And then again, last year, back in 74, there was that gas shortage, double-digit inflation. 2002 was the dot-com bubble, right? And then, of course, in 2008, we had the collapse of the U.S. housing market. But what happened after those things? In all three cases, the S&P 500 did recover in the year immediately following the meltdown. And kind of what I said a couple moments ago is that, numbers don't lie, but they can be used to portray, the situation a little bit better than what it really is. Because, yes, we might see a bull market come up now in 2023. Even though it's just a little bit of a speculation, right? There's some similarities between 1974 and 2022, but let's talk about what really happened in those years afterwards when the market did come back up. In 1974, there was a almost 30% drop. In 1975, it was up 31.5%. 2002, 23.4% drop. 2003, 26% increase. 2008, it was a 38.5% drop. 2009, 23.5%. But just like you just said, like you need 100% return, to get back to where you were, right? So tell us a little bit about what those numbers really look like for someone, let's say, that had $50,000.
Okay, let's talk about 2008. If we're using a $50,000 example, you would have lost 38% of that. And then that in 2008, then 2009, you would have gained 23% back, but you're still behind. Sure, it came back, but you're still behind. Mm-hmm. And taking into consideration kind of loss, then the opportunity cost of not investing in something that would have grown and never lost, you would actually be down $23,000. So yeah, in 2008, if we use the example of you having $50,000 and you lost 38% of that in 2008, and then you gained 23% in 2009, you're still behind. Mm-hmm. And if you think about that loss and the opportunity cost, of not being able to invest that in something else that would have grown but not lost any money, you would actually be down almost $23,000. But if you had that 10% return in 2008 and 2009, that 50,000 would be 60,500 and not 38,000. Does that make any sense?
Oh my gosh, yes.
I know you're a numbers girl.
Yeah, for me, it makes a lot of sense because I am a numbers girl. But I can also see how this can be seen as an enemy of wealth, because you just think about, okay, I went back and then, I'm climbing back up. And so I'm not climbing up enough. And then you brought up something, Chris, that opportunity cost, because not only should people be thinking about getting back to where they were, but thinking about all of the money that they lost had it been an upward growth for their money, right? So that opportunity cost is another thing that people are not taking into consideration, which is huge, huge enemy of wealth, right? So there's years you're playing catch up and not growing your money. Chris, tell me, how can we grow our money, our wealth, without market fluctuation?
Well, one of the ways that I do it, and I have shared with my clients, is using contractual wealth. When you have your money in the stock market, it's kind of like I call that statement wealth, because it looks good on paper one month, then you get the next month and it's not so great. So it just goes up and down. With contractual wealth, that means that it's kind of like a CD. If you put your money in and they tell you they're going to pay you 4% for the next 3 months, that's what you're going to make. That's what you're going to make. It's a contract. And that's really what it means. If say you loan me money and I tell you I'm going to pay you 12% for the year, you're going to get 12% for the year. It's like, I actually really like dealing with private lending and, having a promissory note. It's kind of like, I just like knowing what I'm going to make. And I also like, being able to have my clients, if you want to be able to reach financial freedom, you have to know a number. When it comes to traditional investing, what is the number that they always tell us that we need to try to hit if we're going to be able to reach and have a comfortable retirement? What do you tell your clients, 12%. Or what have you told them?
Well, my clients, I always talk about where they are in their life. I always talk about how you have to figure out how much money you need to have and then work backwards. Because somebody that's starting at 25 is completely different as somebody that's at 55. But when the industry talks about illustrations, they're always talking about that 12%. Is that what you mean?
Well, what I'm talking about really is the $1 million. The goal of having $1 million by the time you retire.
Oh, that's not
so that you can be able to take 4% a year, right? I mean, but you hear that all the time. I hear that all the time when I was doing traditional advising. Like the goal is to try to have
somebody that's going to retire.
$1 million.
Somebody that's going to retire in 35 years. That $1 million is not going to be worth anything. It depends on your quality of life, where you live, how old you are, how much inflation is going to take out to say how much you need for retirement. That's one of the things that I don't say, that there's a generic amount. It's absolutely unique. I call it your financial independence number. Like, how much money do you need to live in retirement comfortably? And I don't think that it's just $1 million. But I mean, if you've heard it, we can both agree that it's not true.
All right. So promissory notes, it has really been a big deal, like private lending and having a promissory note and knowing exactly what you're going to get paid.
Mm-hmm.
I know you've asked me before. So how is that any different from a bond? Bonds are just debt to the government or to municipalities, states. It's just debt, right? So
Right.
it's pretty much the same. I know that you like to know all the little details and
I do. So it's debt.
and
The
stuff like
bond
that.
is
And there's a
debt
lot
to,
of people,
to the issuing person, but it is an investment to you. So if you have purchased a bond, it's an investment to you, but it's a debt to them.
right? Right. These loans are wanted sometimes because some of these companies can't get loans from the bank. However, sometimes the promissory notes are just used in between jobs, like a bridge loan. And these are just, it makes it easier for the borrower because they don't have to wait for the banks because banks are slow.
Right.
When's the last time you tried to get a mortgage? How long did it take you to get, it's there's a lot to it, but yeah, you work with a company or you work with like partner with a company that's been around for a long time. You can be the bank. And that's really one of the best ways that we help our clients reach that financial freedom because the returns, there's no losses. It's just
Yeah.
and also it helps them be able to create right. It creates more cash flow for them like now. That's why we're always talking about let us help you learn how to keep more of your money by paying less in taxes, make more by not riding the roller coaster and making money like most of the wealthy people make it the way they make it. And then also by doing that, you can start living more now. You don't have to wait till you're 65. You don't have to do what traditional advice suggests of putting money away for 45 years. You can start living more now.
Right. And that's the biggest thing for me is that you don't have to wait that long time. You can start enjoying life now because we don't know what, the future brings. And so we don't want to just live for the future. We want to have a nice balance between now and the future. And so I love that. Can I ask one question though? So you mentioned bridge loan. Can you talk about that a little bit more? What do you mean by that?
So bridge loans basically are, so say you're working, I'll give an example. We work with developers and the developer, they have projects going on. And so they have so much money that they have already that they're working with the banks on, but they find another project that they need to get right now. If they want the deal, they got to get it now. And instead of having to wait for the bank to, close out their last deal, they get a loan. They call it a bridge loan, basically 90 days. And they borrow the money and then they're able to purchase and not lose out on that opportunity that became available because they have the funds available to them like almost immediately. And they pay a nice profit. They pay a nice
interest rate
return. Interest rate. They pay a nice interest rate on that money that they borrow. So
what's the risk of something
that's what
like
a bridge
that?
loan is that you know what? It really depends on who you're working with. Like, I mean, the companies that we work with have been around for a long time. So we're not just selecting somebody that's a brand new company and loaning our money to them. It's so if you do that, the company has no background history, nothing, then, it's obviously more risky. But if you have somebody that's been around a long time and has proven record, then the risk is very minimal.
Awesome. And that's why it's so beneficial to, work with you is that you've done the vetting, you've done all the research and found those good companies to work with.
Opportunity.
Yeah.
Yeah. I mean, really, that is what helped me create financial freedom for myself. And I'm so thankful that I found it. How I always say, the less you know, the more they make. Well, the less I knew, the more they were definitely making. And I wanted to flip that script for myself. And the more I learned, the more I found out, the more I couldn't keep it to myself. I had to be able to share these opportunities with my clients.
Yeah, exactly. And they are very grateful, as am I, that you've shared this information with me. Right? Because It's so helpful. It's so beneficial to be able to do something. And I don't know if you have heard this before, but I'm going to guess you've heard it from every single person you've ever spoken to. But we always do feel like the rich know something that we don't, and they're doing something that we're not. And this is it. This is what they're doing, right? And so then there's the fear of like, am I going to do it right? And so it's great working with you because you've done all the research. You've done it for yourself, and you've done it for your clients for years. And so you take the guesswork out of it. And so it's beautiful.
Well, I love what I do. And like I say, right now I work because I want to, not because I have to. And that is exactly what I want for my clients. Because I mean, I don't want to retire. I don't want to do nothing. I want to still bring value to society. And, one of the ways is to be able to do the things that I love, and if we get to do what we love, it doesn't even feel like work. So get to work because we want to, not because we have to.
Exactly. Just get to live your passion, right?
Right.
Well, thank you for that, Chris. I learned so much. You answer all of my questions always, but I'm curious, did we answer all the questions from the listeners? We want to hear from you. What do you wish you knew more about? What do you wish that we explained a little better? Like if you heard something that you're like, oh, I want to hear more about that. Let us know. You can leave us a 5-star review on Apple Podcast and ask in the review, or you can send our Facebook page a message and we will talk about anything that you request.
Well, that wraps it up for this week. And thank you, everybody, for tuning in. Join our Facebook group, CashFlow Hacks, and follow our page on Facebook, PQ Consulting Services. We're also on Instagram, so check us out. Thank you for listening. And next week, we will be back to talk about the rest of the 5 enemies of wealth, the last 3.